I think we have Charlie. You there with us?
Hello?
Hey, there you are, Charlie. How are you
Hi.
doing today?
My voice is very soft, so it may not come through very well.
Oh, no, you're fine. I was just mentioning, relative strength. We were talking about it before the show, and I know you're a big fan of relative strength. I don't know if you had any comments on Signet Jewelers before you get into your presentation, but do you like it when a stock is in a strong group, has been underperforming, and then all of a sudden comes out with some really solid fundamental news and looks maybe to be turning the corner? Does that interest you, or do you need to see a little bit
Yeah,
more?
absolutely, sure. I run various significant numbers on stocks relative to all other stocks, and this looks particularly good, at least as of today. It didn't yesterday.
No, it did not, but they do have fundamental news that kind of changed the picture. We'll see whether or not
Yeah.
the technicals continue to hold up. But I'm going to let you get into it because I know you got a lot, and everybody is really kind of sitting on their hands and trying to wait and get this information that you're ready to share with everybody. So I'm going to let you take it away.
Okay, good. I had asked Tom and Aaron what they thought was most interesting or the subject most in demand to cover, and they mentioned volatility and risk, and I suspect that that's because where the market is high as it is, and with only some stocks participating, people are interested in how they can protect themselves. Where was I? Oh, okay. Let's look at first at the generality, and that's what do you do when you're investing? And so there's a number of decisions that have to be made, and the first, of course, is that whatever you have to pick an investment, and that's what Tom and Aaron are helping out now. The next step is to actually buy it, and that's a separate decision. Not one that one that a lot of people labor over, but it's actually the easiest decision in the whole process of investing. The next problem you have is, what do you sell it? If it goes up, do you sell it right away? Do you let it go with the fear that it may come back and you don't make any money? Or on the other hand, maybe it's at a loss. And how do you know when to sell it when it's declining? That's the element of risk that I want to talk about. And it all boils down to having some kind of risk plan, as to what you're going to do. Because when you get to a loss, of course, you invite all sorts of psychological barriers there about being stupid and why did it go against my best judgment and so forth. So most investors, as this outline says, spend their time picking and buying when really they should be considering what their risk is. And it's very rarely considered. So the next major step is to come up with a risk management strategy. And in fact, you'll find that most professionals don't have a good risk management strategy. If you own a mutual fund, for instance, if you ask the manager, what is the specific criterion you use to sell a stock, you'll often come up with some kind of a generality that's not a plan. It's not a strategy. And this is equally so for most people. But it's a terrible error because the law of percentages is working against you. Now, a lot of people consider risk to be equivalent to volatility. Volatility is a measure of risk in a very specialized sense, but it is not. It's not going to save you. Volatility doesn't tell you anything really, as far as risk is concerned. The two most common measures are the Sharpe ratio and the I spelled his name wrong, I think, option calculation. And so your question is, or most question is, do you buy low quality, no volatility stocks because you're supposedly risky? or do you buy high volatility stocks because they're going to make you more money? And the use of the standard deviation is a terrible mistake because it doesn't measure risk. It measures volatility, but volatility is not risk. And when we boil it down, the let me show the next one. This is a hypothetical situation. The vertical axis in this case would be the standard deviation. A stock that has declined by this amount has the same volatility as a stock that advanced by this amount. So volatility would not help you in this. It has no bearing on whether you make money or not. Whether you make money or not is if you buy volatility, high volatility, but have a risk plan that gets you out of it so that you don't end up being like stock A. And most volatility measures don't consider the upward volatility, which is favorable. Let me switch this. Okay. So risk management is really the science, if you will, of preventing you from buying or keeping stocks that are potentially going to decline. That is called the drawdown. Drawdown is really the measure of risk. It's a measure of how much money you're going to lose or what can you lose. And that's your concern when you buy a stock, not whether it's oscillating back and forth. It's whether you are going to lose money on it. Now, you're never going to get it perfectly, of course, but your attention should be focused on what is the likely drawdown. Now, we got two kinds of risk in the marketplace. Actually, these are the most common or largest. You have market risk, which is if the entire market declines. And the problem with that is that almost all stocks go with the market on the downside. So if you're going to be a successful investor, your best bet is to, of course, not participate in the market decline and to save your money for when it bottoms. Now, a lot of people say that's a difficult thing, but it really isn't. There are very simple methods of determining whether the market is headed downward or not. Moving average crossovers are probably the most common, and I use them. Momentum oscillators, yes, but they don't work as well when you're rising. And then you have ancillary information, for instance, interest rates, as Tom's talking about. You have sentiment measures. You have debt measures, consumer confidence, and so on. So when you begin to see all of this stuff falling into place as to when it usually occurs at a market top, then once the market starts to go down, you'll get the confirmation with your moving averages. You have to get out of the market. You cannot ride it downward. Now, ironically, most fund managers are forbidden from selling the market. And this is a decision based on sales of mutual funds, not of management of mutual funds. The sales department is very important in most mutual fund companies, and they don't want you to sell because they can't turn around and sell the fund to somebody if it's only got a large amount of cash. So most fund managers are stuck on that, even if they could time the market. It's also something for you to remember. If you happen to be in mutual funds, they can't go, or in most cases, they cannot go into cash. And that's all called market timing. Now, the other risk you have, of course, is in the individual security that you own. And in order to measure the minimum drawdown, which is your risk, it is your risk. You have to go back and look at the history of the stock. I'm assuming we're talking about only stocks at this point, but this is equally valid for anything, real estate or, commodities and so forth. prices are based on their trend and the volatility about that trend. The trend is measured by relative strength. And for this reason, I very strongly advise that you buy stocks based on relative strength. Now, the problem that most people have is that they want bargains and therefore tend to look at stocks that have low relative strength, and they're hoping that it will turn. And some do, some don't. But the problem is you don't want to waste your money in a stock that's not doing it. You want to put your money into something that's very strong. Now, then the question is, how do you know when to sell it? And the most popular amongst the hedge funds is using what's called the ATR. The ATR is average trend range. Now, the trend range for most people is what's the difference between the high and the low during let's say a day. But a fellow named Wells Wilder came up with another way to calculate that using 2 days. And the reason he did that is because if you use just the range between high and low and the stock gaps the next day, it's not your measurement for high and low is not telling you
the period that
what the actual
watching,
change in the price,
but it gives you a rough idea.
So he just
of what the range is that you can expect
that you use the close of the previous
the
day,
stock
and you measure the high from
changes
today
direction.
versus the close, the low.
It's obviously
today
at some
versus the
juncture
close,
going
and
to
the actual
the
range,
trend is going to
and
turn.
whichever is the largest.
And when the trend turns, the oscillations
the
will
calculation
become
then you average
larger
on
the
downside
period
of time,
and at
what
some
you
point
get is
they will sort of the average
if it's true that the
oscillation of
trend
the
has changed,
stock at some
in
point they will break
dollars,
through the behave
for
in
that
a manner that
for the
is
period that you're watching,
but it
well,
gives
I
you
guess
a
you'd
rough
say
idea
wider,
of what the range is
and
that you
for
can
instance,
expect in the future.
If
Now, if the stock changes direction, it's obviously at some juncture going to the trend is going to turn, and when the trend turns, the oscillations will become larger on the downside, and at some point they will, if it's true that the trend has changed, at some point they will break through and behave in a manner that is
well, I guess you'd say wider. And for instance, if the stock is moving upward at a regular pace, when it declines more than what oscillation occurs, what an ATR occurs, you know that something strange is happening. Now it can do it upward too. It doesn't have to always occur on the downside. But what you do is you create a trailing stop. It's called a chandelier stop, which and it's a trailing stop, and it's based on the high of the stock as you own it, and it's measured by how many ATRs are below and above the stock price at any particular time, so that when and if the stock price declines below that ATR, you know there's a change in trend occurring, because that's out of the ordinary, and it's changing downward in that case. So people will use that as a stop, or what they'll do is they'll take maybe 2 times or 3 times the ATR, just in case this random hit. And but if it's down 2 times the ATR or even 3, then you know you got a real problem and you should sell it. It's not something that you should be interested in anymore. Now, I give you the how the true range is calculated. As I mentioned, it's all based on either the close of the prior bar or the current bar range, and whichever is larger is the one that's used in the calculation. Here's a picture of the true range versus the standard deviation. Standard deviation is used mostly in option calculations, and it is also used as a means of
determining risk. The problem is that standard deviation is based on the closes, and it's based on the percentage change of the closes. And it doesn't include the high and low and the actual range that the stock might travel through during a particular period. So the average true range does do that, and that's why it's used much more amongst the professionals. So if we boil it all down, your object, of course, is to buy a strong, very volatile stock and to reduce the risk of a drawdown. And to do that, you have market timing, which gets you out of the market entirely when the odds are increased that you're going to lose money no matter what you do or how smart you are, because that when the market starts going down, all stocks go down. But however, when the market is advantageous and is rising, as it is today, you use relative strength to select stocks. And I'm talking more about not so much trading, but more as an investment vehicle. You could also use it for trading too, of course. You want to trade the highest strength and the highest volatility stocks. And that's your secondary criterion is you buy the high relative strength stocks, and then you buy those that are in that category that have the highest volatility, because you're going to get the most bang for your dollar. And to prevent a large drawdown, you use a trailing stop, as I mentioned, with the number of ATRs. So it sounds very simple, but and it is very simple actually, but of course then you get all the psychological problems that occur with investing. Now, I don't know whether you have any questions or not, but I certainly
what you were just talking about. But when I look at a stock like Apple, here's a company that, when we look at the market cap, it's almost $950 billion, almost $1 trillion company.
Right.
I don't know what you thought about this, but I mean, 10 years ago, I never even dawned on me that we were going to have $1 trillion company, within the next decade. Does it bother you that a company's got that size of a market cap? Is that something that you consider to be risky, or do you just continue to follow the charts?
Yeah, I don't look at market cap except from the standpoint of liquidity. I mean, can you get in and can you get out? Most of my customers are institutions, and they have a restriction on the amount of money that they can throw at a stock, and not affect its price. So Apple, of course, would be a very liquid stock, and therefore would be one to be considered. But if, on the other hand, if it's not very strong, then you don't want it. And whether it's a big company or little company, the odds are going against you if it's not in that high category. So bottom line is, yeah, sure, but it's got to prove itself with strength and volatility.
All right. Do any of these, any of the big companies, the FANG stocks, because so much money has been pouring into it. You always worry about, the masses because so much money is rolling into certain areas of the market or certain individual stocks. Does it bother you to see Apple and Amazon and Facebook and Google, Netflix, all these companies seemingly going up year after year without a really significant pullback? Does that bother you, or is it similar to Apple in terms of, just being okay with it so long as, charts aren't breaking down?
Yeah, no, that's not a consideration. As you know, I mean, well, and as you pointed out, some stocks will go up for a very long time. But then, yeah, you like digital equipment and some of those others that get crushed in the market declines 10 years ago. Their end will come, but you don't know when it is. And so if it's still in that category, in that very high, strong category, it doesn't make any sense to sell it. And for instance, I was just looking up Apple right here. I got a relative strength of 83. Well, that's pretty damn good. It's not way up there, but for, as you say, a heavily capitalized company, that's pretty good. And as long as it stays there, then you keep it.
I've got one stock, and I'm trying to, kind of zero in on how you look at relative strength. So I'm going to pull up a chart of a stock that hasn't really been doing too well in 2018, but has a really nice long-term track record. And that is Monster Beverage, MNST. And I've pulled up on the chart here, 15-year chart of Monster, where it was down, under 10 cents a share 15 years ago. Now it trades at $53, but it is down from, being much higher recently. Let me get a daily chart in here. And if you look at a daily chart, you'll see that Monster over the past 4 months has been declining from $70 down to 53. So when you look at a stock like this for Monster, are you more inclined to follow what's been going on here in the short term with a couple of these gap downs and the trend lower and obviously the poor relative performance over the last few months? Or would you be more inclined maybe to step back and look at that longer term chart where we've seen such great returns on Monster? How do you look at an individual stock like this?
Well, the first thing I do is go and look and see what the relative strength number is.
Okay.
In Monster, it's 6 out of 99.
So you don't like it. I think that's fair to say, right?
Well, yeah. Well, see, I'm playing odds. It's pure odds. I mean, I've back tested all this stuff and run it and walk forward optimizing and all this sort of thing. And well, as it turns out, the way it's calculated is the current price divided by a moving average, and the best moving average is 31 weeks. Well, that's about 3/4 of a year, and so it's a sufficiently long time to work out the sort of minor oscillations. And by using that, and again, testing what happens if you choose a stock with a relative strength of 6, there's no question you can hope that it returns, but the odds are against it. And your odds are much better. It's sort of a buy high and hope it goes higher kind of investment method. But in my mind, and all the tests that I've done, it is the most successful way to do it. Now, if you're going to trade it, that's a whole different question.
Okay. So it really depends on your time frame and your own strategy, obviously.
Yeah, when you see, it depends on when the company may be great. I'm not questioning that. It depends on when you actually get enough buyers to start running the stock. That's, in other words, you can come up with a great story, but you can sit with a great story for a long time and nothing happens. It's only when the stock is bolstered by other buyers that something is happening, and that's when you want to jump in.
One follow-up question. I know Aaron's got a couple questions for you from the chat room, but we were just talking about the interest, having having the institutions and so forth interested. When you talk about relative strength, I'm assuming that all you're looking for, when you say that Monster's a 6, that this is based solely on price action. How much of the volume, how much do you pay attention to volume as a stock starts to move higher?
None at all.
Okay, it's strictly based on price.
Pure price. Yeah, that's what you're buying and selling. So, and I don't mean to denigrate volume. I mean, volume is a very important statistic, but in this particular method, it's irrelevant.
Okay, gotcha. Fair enough. Aaron, you have some questions?
Yeah, we did have, let's see. You've answered some actually in your questions, Tom. One person was interested in, when do you use stops, Charlie? And if you do you use points or do you use like a percentage or, for your trailing stop, if you were to use points or percentages?
Yeah, some people do that, but the problem with that is that if a stock, its character changes and it becomes more volatile, in other words, it swings in wider swings, you don't want to get caught in a stop with one of those swings, because the swing itself is purely an oscillation. It's not a change in trend. And that's why I much prefer to use the ATR, because that adjusts back and forth as to how the stock is oscillating, whether it's and so in that case, I wouldn't use a percentage change. I would use the ATR. I use like 2 or 3 ATRs as your stop point, your trailing stop point.
Now, I just again, a follow-up here. I pulled up Apple and I put the ATR in here. Is there a certain level for those who are using the indicator at StockCharts? Is there something that would really maybe trigger your concern holding Apple based on the ATR? I mean, is there something you'd be looking for here?
Well, yeah, you've got the ATR itself, but what you want is to make a chart where the ATR is following the stock price itself. You can see that it rises when the stock price rises, and now is declining. Usually that's a sign when that something big is going to happen. As you know, low volatility leads to high volatility, and usually a directional change. So now it doesn't mean you can't foretell whether it's going to be a change upward or downward, but again, what you do is you draw a line that's, let's say we use two ATRs. So the ATR today is, what does that look like? 275, something like that?
277. Yep.
Yeah. Okay. So if we took say a three times the whatever it is, so you get something up around 12 and a half, somewhere between 12 and 15. So you then draw a line that is, or a dot that's 15 points below the close on the chart. And then the next day you do the same, and the next day you do the same. And you'll see that at times it's been up as high as 4.5 points, which again, if you'd used the 3 times, would give you a much higher number for your plot.
Right.
And if it breaks that line, then you know that the stock is doing something not ordinary. It's something different.
Do you ever?
Yeah.
Oh, go ahead.
No, go ahead.
I was just going to say, do you ever use like recent price lows themselves as maybe a confirmation to what you're doing?
Well, yeah, you could certainly have like a breakout from a support or a resistance.
Okay.
But and that's your confirmation. I mean, I'm a great believer in not acting on any one particular indicator, but having another indicator confirm what your first indicator is telling you, and having it come from a different source. In other words, if you're using a stochastic, you don't want to use a RSI as a confirmation, but certainly a breakdown or breakup would be different.
Yeah, I think you raised a really good point there, because we talk about that a lot with technical indicators, that, you know, you can always find one technical indicator if you go back and back test that happens to be working pretty well in history. Right. But then all of a sudden you start putting your money into it and you're like, why isn't this working anymore? And the problem is you've just got one technical indicator supporting your thesis.
Yeah, exactly.
Yeah, you need that. Do you have anything else, Aaron?
Yeah, I know you've talked about it as you've gone along, but is there, you talked about, I think Monster having a relative strength ranking of 6.
Right.
What exactly is like your formula? Like, if the thing is, people are asking, how do we scan to, you know, build a scan from it? So, I mean, in particular, you know, what formula do you use to come up with those?
All right. Well, the formula is and this is in my book on investment and trading strategies. The formula is the closing weekly price as a ratio to its 31 week moving average. So you take that ratio for every stock on the exchange. There's, I don't know, 8,000 of them, and you measure. Then you rank them all, and then you divide them into percentiles just for ease, so that you can quickly tell whether one is stronger than the other. And so when you get a ranking of 6, it means that 94% of the stocks on the exchange are doing better.
Mm-hmm.
and then, you know, my tests, of course, have been, okay, let's say I buy it at 6. What happens statistically over a period of time? And you lose is what happens. I mean, In other words, the relative strength ranking tends to stay the same for a substantial period of time, at least 6 months, but not always. And if it starts to change rapidly on you, then you know you got a problem.
And you said that you're taking the price weekly close and dividing it by the average of the last 31 weeks, did you say?
That's correct.
How did you come up with 31?
Purely by experiment.
Okay. So, I mean, it's safe to say, I mean, when you look at a stock like, Monster, again, if we go back on that monthly chart, it's got a great long-term history, but the calculation that you're coming up with is really focusing on the past a little bit more than a half year. Half year would be 20 weeks.
Right, exactly.
So it's really ignoring everything that took place prior. So the one limitation, if there is one, is that it's more of a short-term evaluation of relative strength.
Yeah, you're correct. If I use a longer one, it won't work.
Okay.
I've tested it all the way out to 2 years, and 2 years on that moving average. And when you get out there and you find that the results are random, you don't get any advantage.
Now, when you see a stock like Monster, which has got a relative strength under your calculation of a 6, is there a level that it gets to that begins to get your interest? So let's say we start to see a short-term rally in Monster. Now, all of a sudden, the next time you do the calculation, it's at 20, and then the next time is at 30. At what point does it begin to draw your interest in something you might want to take a look at?
When it gets to 97, 98, or 99.
Okay, so it's got a ways to go then.
Yeah.
Okay. Perfect.
Well, I mean, there's a lot of stocks out there, so you're trying to get the best one. And that, to me, is how you do it, Monster, I mean, it'll happen someday. I'm not questioning that. But right now, you want to have the strongest stocks that exist.
I'm just curious now, what's your relative strength ranking on like an Amazon?
Okay, hold on a sec.
I would think it's going to be in the 90s because it is up for 2018. It's got to be doing better than a lot of stocks.
Yeah, it's 92.
92, okay.
For those of the listening, the StockCharts technical ranking is determined in a different way. So if you go to Chart School and look that up, you can make those comparisons. But at this point, they're two different relative strength ranking systems.
There's a lot of them. I mean, Value Line has one, and I think O'Neill has one. And the problem is that when they're tested, now I'm not saying this about the stock charts because I don't know what the formula is, but when I knew or could find the formula for these various relative strength rankings, I found that you just didn't get anywhere near the performance you do with this. For instance, a lot of them try to combine, short-term relative strength plus intermediate plus long-term, or they use a percent change, for example, between today and, it's a rate of increased business, and those are flawed just logically, but it turns out they don't work, and I don't think that relative strength is the magic thing and it works all the time. It doesn't. You're playing odds. Let's face it, that's what you're doing when you're investing. You're playing the odds that you get a real good stock that works to your advantage, but it only works during certain periods. It works, for instance, if you shorten the time period that you calculate the relative strength, you actually get a negative correlation. You get where a strong stock is the worst thing that you can buy, because what you're doing is you're shortening down to its cycle, and it will correct during that cycle. Once it's made a short-term peak, it'll correct down and you lose your money. So the time over which the calculation is done is very important. And as I say, the longer you get out, the less it tells you anything. It's just almost totally random. So it's kind of that sweet spot in there.
Yeah, I will say that this has been an awesome visit for sure, because I think two of the things, is we've had a number of guests on here and things that Aaron and I talk about, and a lot of the questions that come up in the chat room and so forth. A couple of areas that we tend to focus on quite a bit is relative strength and managing risk. And I think you've done a great job actually of taking a look at both of those for us today, and kind of giving everybody an insight into how you manage risk and how you look at relative strength. And so we certainly appreciate you coming on and sharing all this with us, Charlie.
Okay, well, I thank you very much for inviting me.
And we're going to have you back. So make sure that you got it marked on your calendar. We're going to get you back. I know everybody would love to hear from you.
Come up with something new.
There we go. Thanks.
You always have something great to say.
Always. Thanks again, Charlie.
Okay, great. Thanks for you guys.
You've got a problem. Your investments aren't growing as fast as you'd like. So you did a smart thing. You opened an online brokerage account and started learning more about the financial markets. But now you have a bunch of new questions, like, which stocks should I buy? When should I buy them? When should I sell them? You tried watching the talking heads on the financial channels, but they just gave you untimely advice that the real pros already knew about. It's all starting to feel a bit too little, too late. But what if there was a way to know, to truly know, what the market was thinking and how it was behaving, even before the pros? What if you could learn where the market was headed while there was still time to profit from that knowledge? With StockCharts.com, you can. Trusted by thousands of online investors, StockCharts.com has the charting tools and analysis resources you need to make smarter investing decisions. Our intuitive web-based tools make it easy to create high-quality financial charts in just a few simple clicks. Save and organize the charts you're watching to make managing your portfolio a breeze. And when it comes time to buy, our unique technical ranking system sifts through the markets and quickly points you to the most promising stocks and funds. You had a problem until you found the solution at StockCharts.com. Start your free 1-month trial today and see what superior financial charting can do for you. StockCharts.com, simply the web's best financial charts.
This is a brief tutorial on using stochastics. Big word, but wonderfully simple. The idea behind stochastics indicator is that as the price moves up, the close tends to stay close to the highs, or the price action throughout the day tends to stay close to the highs. And as the trend weakens, it has trouble staying near the highs. The stochastics will point this out. And the reverse is true at the lows. So as price is declining, all of a sudden it stops always closing near the lows. So not to get confused with %D, %K, %R, that type of thing, Henry Ford started with the Model A and went B, C, D, E, F, G, all the way through to T until he came out with the Model T Success. And so when George Lane and his colleagues were doing that for stochastics, they kept working their way through, and they did the same thing. They used %A, %B, %D to try and find a rhythm that worked out nicely. So what stochastics does is it takes a range over the last few days, in this case a 5-period. Stochastics would say that from this point to this point is 100% and price closed at 82%. And then that would be %K, and then %D would be a moving average of that. And it's important to remember on stochastics, according to George Lane, there is only one valid signal, and that is the divergence on %D. So you're looking for the divergence on moving average, and I'll show you that on some real live examples. So here's Apple, and I've got these stochastics set up slightly different. So this is a fast stochastic, this is a slow stochastic, and you can see that it's much smoother. It's got these whipsaws taken out, and that smoothing function is what %D is changing for us. And then the full stochastics here, I've changed the period to 14 instead of a 5-period stochastic, just to show you that it gives you smoother signals, and so it's a little easier to trade with a 14 period, and that would be the default at StockCharts. But depending on how aggressive you want to be, you might find that there's a better way to trade. So all of these signals are important, but what the big clue you're looking for here is this positive divergence where things are improving while the momentum is coming down, and you're starting to see the stock whipping around at the bottom here, usually a sign that something's getting a little more volatile and you might get a chance. So, a nice trade like this would be a great move of $30 or something like that, and it would have got you in relatively early. Here is USO, and what we want to show you on this particular area is you can see how the price is actually struggling to make any moves higher. And even though percent K keeps banging on the top here, the percent D, which is the moving average, this purple area, is moving down and making a lower high here. And it's that lower high that is our divergent clue that we want to be aware of. And then that's going to give us our sell signal. And in this case, we've got double divergence with another lower high way over here. And that is a real clear signal that George Lane likes to talk about. When you get those, it's a very valuable signal. So you're looking for the divergence on the moving average. And again, in this case, I've set up all three as 5 period moving average, but our default is 14, so you could set them up whatever way you'd like. And the way you do that is just select them from the drop down menu in here, and then pick the time period that you want.
So in the book itself, just so everybody knows, it's all StockCharts charts. It's all StockCharts setups, but I talk about why to use candlestick charts, why you might want to use line charts, bar charts, mountain charts like you'd see on the business news networks and those kind of channels. A lot of it is about the settings in StockCharts and how to make great charts. This is actually a book about building your base, understanding how to make the chart display the information you want, all of the little trick settings. I think it came out pretty well. So in the book, what I try to do is show how to get things set up, specifically about overlays and indicators, how to turn them on, how to change the settings, how to make them show up the way you want them to. And so if you're struggling with any of the sort of chart settings, that's an important part. With that, thanks everybody.
I want to show you a little charting trick that I like to use for the percentage price oscillator, or the PPO. On this SPY chart here, you can see in the indicator windows, I've got 2 PPOs. The first is the traditional PPO. It's the black line there, and that's the difference between the 12-day EMA and the 26-day EMA. And you can see it's above 0 when the 12-day EMA is above the 26-day EMA, and below 0 when the 12-day EMA moves below. The red line is the signal line, and it's set at 9. So it's a 9-day EMA of the PPO. And you can identify downturns and upturns in the PPO with that EMA. And the histogram is the difference between the PPO and its 9-day EMA there. You can see when the PPO is below its 9-day EMA, the histogram is negative. And then when the PPO is above its 9-day EMA, the histogram is positive. Now, the little trick I want to show you has to do with the PPO 50, 200, 0. That's the second indicator there. And what I've done is I've eliminated the signal line by putting 0 as that last parameter. So this PPO shows the percentage difference between the 50-day EMA and the 200-day EMA. And you can see that it shows as a histogram when using these parameters, and it has been positive for over 6 months, actually for over a year, actually for over 2 years in this chart. And we can see that it's currently around 3.1% difference. That means the 50-day EMA is 3.1% above the 200-day EMA. And we can confirm that by going to the annotate button there and choosing percentage change. And if you measure the percentage change from that 200-day EMA, the red line, and I go up to the 50-day EMA, there you can see we're about 3.1% difference. And so that's what the PPO is telling you. And so I like to use that longer term PPO to get an idea of the long-term trend.